Will the financials save the US equity bull market? That's what we are going to see today. In fact, the US markets is showing some sign of weakening breath. We see here on the upper side the small cap, whose relative strength is going down during the month of July. Similarly, also for the mid cap. And we see that the mid cap are just stalling below the resistance where it hit resistance in January. So despite higher highs for the small cap, mid cap are still within the range. Also, if we look at the Nasdaq, we do have a powerful uptrend on the relative strength versus the S&P 500, though in July it is pausing a little bit. We see higher highs, but the momentum is displaying some weaknesses. And if it turns around back below the level we just saw at the beginning of the week, then possibly a correction or pullback to the bottom of the Bollinger Bands could happen. So the key question right now, with the leadership being weaker on the technology side, is the financial. Will the banks, US banks, be able to break up this nice descending triangle and explode above the upper Bollinger Bands toward 30 and possibly 34 along rising relative strength of financial sector versus the S&P 500 to sustain the upward momentum and allow the whole index to pursue on new highs? That depends, of course, on this black line here. And this is the US 10-year yield. We are going to see it more in detail here on these weekly charts. You remember that rates rose from 2% to 3% in April and then consolidated. Indeed, they have been in this narrow trading range between 3.1 and 2.75 for a little while. Especially in the short term, they have been in a very narrow range, as we're going to see on the next slide. But here, this major descending trend line coming from 1981 is indeed a strong resistance area and could cap the rise of the market. So the current breakup could be short-lived. If that's the case, we expect then a pullback toward 275 or 270 in the fall. And why so? Well, on the short-term trend, on the daily side of the US yield, we see that we have made half the way between 280 and 305. If we fail at 305 and pull back down, then we will not have the major rise that everybody is speaking about right now. And that might have an impact on this black line, which is the S&P 500. Usually, when rates decline a little bit, that means that people are buying bonds because they are not buying equity. What has been the other impact of rising rates so far? Here we have in green the US yield, as we see rising here, and we see the relative strength of emerging market versus the S&P 500 coming down. So obviously, rising rates have been bad for emerging markets. And we see that since the beginning of 2018, we do have a downtrend for emerging market, which has reached support, which was a famous resistance in 2014, around 41. Momentum seems to rebound a little bit, so we do have a little rebound, but not yet really a break of the downtrend line. So emerging markets are really not helping a lot the rise, the slow rise of the S&P 500. Therefore, we need probably to review what could happen during the summer. You remember, we had in April drawn this red line, suggesting in April that we could rebound toward 2800 or 2850 or even 72, 2872, the former high. We'll see now in July that that has happened about as explained on the red line. It's still tracking very well. If we are rising above the upper Bollinger Bands around 2844, maybe we can extend toward the old high. But if we fail and start to move down, or if we move up and then reverse back down for any reason, then these are the two potential paths that a pullback or a correction of 10 to 15%, even though 20% could take place. And that would take place along a very old cycle which has been forgotten now for almost 16 years. This is the 4-year cycle, which is due somewhere in October of 2018. So certainly we need to check out on the daily charts very carefully, not only the small up and downs along these small cycles of a few weeks, but really what's going to happen here near the resistance levels. Any reversal below 2800 might be the beginning of the signal for a correction. We see already there is, in that case, bearish divergence on daily charts as well as on weekly charts. And what are the other markets area, geographical area, like Europe and Japan? Well, frankly, they are not helping a lot. The relative strength of Europe versus the US is flat. Even one could argue it is still in a downtrend. And this despite a rebound in the last 3 weeks. It's still capped by strong resistances, despite the momentum turning up a little bit. And further, in Japan, the situation is about the same. We still haven't broken through resistance trend line, and the relative strength versus the S&P 500 is still relatively flat, possibly a little bit down, and the yen is not really weakening a lot. It's about flat. So we really have to envision cases for a potential correction in the S&P 500 from midsummer into the fall. I'll see you next month.